Okay, well, I appreciate the chance to speak with you. And our focus is on managing risk in grain markets, examples and applications. So we're following somewhat on the heels of what Brian had talked about, particularly when we get down to the applications with regard to forward contracts and what they accomplish relative to what put and call options accomplish. My colleague in this is Mark Nelson from Kansas Farm Bureau. Mark and I have been working on a number of workshops called "Winning the Game" Grain Marketing. It's a focus of it is well, the title is "Winning the Game." Grain marketing strategy workshops, but really is an effort, I think, to bring some structure and disciplined thought to our pre-harvest grain marketing strategies and approaches. So we'll show you the specifics of this as we go, and then about two-thirds the way through, then we'll shift back over to looking at specific examples in today's corn and soybean markets that would make use of some contracts basically in the Salina and Garden City area, forward contracts, and then add in the option side. So here we go. So as we kind of look at grain marketing strategies, so what's great grain marketing? I think over time, it is the rare individual that can quote always guess or manage and make tremendously optimal decisions in these markets year in and year out. On average, U.S. farms earn about 10, 20, 30 cents per bushel, including government payments. So one way to view that is if 20, 30 cents a bushel is the net at the end of the day, gosh, if we can make 5 or 10 cents over all costs and then add that 5 or 10 to our bottom line, well, we've increased our profits a third or half. So that's a worthy goal. It's not about necessarily finding the high, given all that's happened in these markets. So here you see a chart of monthly corn prices from 2000 through 2020, and you've seen droughts, ethanol, expansions, trade wars, everything in that. A lot of those things, some that could be anticipated, others that you couldn't. So we're I guess as a long-term focus, we're looking at making an extra dime or so that we can add on to the bottom line and really enhance our net. So and also, in particular, with regard to what Brian was just talking about, there's a place for some of these asymmetric price risk management tools that can help protect us from big mistakes or big surprises in the market. So again, for the first part of this, we're going to talk about organizing a grain marketing plan and specifically don't want to take the old stale approach that maybe that people like myself have been guilty of in the past. We want to present more of a comprehensive plan that both looks at the upside, but then what do we do if we don't achieve that upside? So to organize a grain marketing plan, again, we're looking at something that would be a proactive strategy for price your grain both before and after harvest. And again, you've got a lot of things to consider in a marketing plan. First, crop production, of course. Right along with that would be crop insurance. And if we're looking at a pre-harvest plan, then that crop insurance coverage that would give us replacement bushels or the ability to fulfill a forward contract if we happen to have a loss and market prices went higher. That's a pretty major thing. Price needs and objectives, again, cost of production, and from cost of production, then we're looking at what we need over time, perhaps in a scaled up manner to take advantage of that. Storage capacity is a big deal, and it's some farmers, some parts of the state have more storage available than other parts. So commercial capacity, on-farm capacity, all in play. Financial cash flow needs, and really, I think we don't want to underestimate how, as individuals, how we may have different attitudes towards the use of either different tools, how we view them. Are they risky just inherently, or how much we ourselves have placed great value on not missing out on an upward pricing opportunity. So marketing plans and action plan it includes pricing increments, targets, and dates that guide your decisions and help take the emotion out of marketing. That's a nice lofty statement. But when we actually show you our plan, or not our plan, show you a plan that you could consider, then between Mark and myself, we'll explain it and then really invite your critique on it. Does it make sense? So it's coming down the road. So we want to be in the position of not so much saying, should I sell today, but rather to have thought ahead, to have these plans, and to be able to say, well, my sales are complete for now. I've got this plan that I'm carrying out. So I think that would take a lot of stress out of farming just in itself. Want to take a look at some of the price variability that we're dealing with or looking at. So we got these from our colleague, my former colleague, I consider him still a current colleague, Art Barnaby, who's looked at revenue protection insurance prices, the difference between February averages for Dees corn and the again the projected prices, and then the harvest prices would be the Dees contract and the same Dees contract, but during the October time period. And you see a lot of ups and downs there. I think Art put out an article on Ag Manager yesterday that talked about how I think 39 out of 48 years you have sideways, pretty much sideways to lower prices from February to December. So that kind of impels us to look seriously at corn as to what we can do. The on average, if you look at where we've been at since the 2012 drought, you can see that there, the price run up that we've had since 2013. And again, inherent there is we haven't had the big one, the big drought. So to keep that in mind, we've had a flood or two, but since 2013, the range of those changes, $1.26 of December, the October average being below the February, and only last year did we have by 11 cents that the December average was higher than the February average. The average overall, 48 cents. If you're a stat geek, the median is about 32. So those early years, 2013 and 14, had a lot to do with this. And note that coefficient, it's a economist statistical measure, coefficient of variation 1.0. When we put this chart up for soybeans, it's 3.4. So relative variability on this outcome for soybeans is, well, it's 200 or 300% more than for corn in terms of this thing, what we're looking at. I hope I've said that correctly. And a lot of what we're doing in looking at this at the kind of a recommended view, well, our proposed, better word to use, view of considering pre-harvest grain marketing strategies is, of course, to look at the seasonal patterns that we've got. CME Group, Dees corn futures, 15-year average index, we have tended on average to go from, again, you can see here during the March, April timeframe, we've tended to move higher from May into June. Note that of late, our times of greater price upward movement has been more during June than during July. So that, we've just got the crop in the ground, a lot of uncertainty, and there you go. So this is kind of a prime time that if we follow historic indices, that we'd be pretty concerned about some pre-harvest pricing. So shouldn't we be pricing here? Well, yes, with the caveat that sometimes it doesn't always happen. Here you can 2020, you can see in the blue line that coming out of June, July, well, with all the problems we had, prices were moving higher. 2010, 2006, you go back in time, you've got some other years where we had contra-seasonal trends. So it doesn't happen every year, and therein brings to mind the idea of what's the place for ag options. We talk a lot about puts, setting price floors, and that's of value. We talk about calls, being in position with those to take advantage of how the futures might run up. So there's that would be, for these years, again, 15, 20% of the time, you'll have some contrary things happening, and that's where these options tend to come in. From our own KSU Ag Manager website, we have corn seasonal prices. These are cash prices. Interesting that the long-term seasonal index in the purple would show that we tend to see prices come out of November, December, and move up on average fairly steadily on up into June, and then begin to decline. Note the 85 and 15%, those are percentiles, that you have sometimes a pretty great risk. April a little wider, of course, June, July, all wide. The red line has to do with what current futures are saying. So if you go back to September, from September all the way to February, we've been trending up higher. Now, and what you see is the current futures from where they're at with the upfront month, they're tending to decline off into harvest. I'd contend this is, in a lot of years, this is sort of what happens. The futures kind of express a lot of their opinion in the upfront month, and they tend to move up and down from there. But so what you're seeing here is the thought that we're going to plant more corn acres. We'll have a successful crop. We'll tend to rewrite the ship, in some people's view, in terms of rebuilding stocks. And so you've got new crop D's futures fit well. As I look here today on another screen, right now D's corn trading at 481, March at 561, so 80 cents. So what's the market? How's the market weigh what they think the downturn in the futures will be? Well, as of about 10 minutes ago, about 80 cents. That's how they view it. Now for soybeans, you look at the same type of a situation, and from 2013, and you've had some ups and you've had some downs, a range of 170. Well, and it'd be this time frame in here, from again 13 out into there. You've got some lows, you've got some highs, average of 32 cents. Coefficient of variation 3.41. It was 1 for corn. So and very likely this has to do with the South American strength in production, the demand from China come into play, and how trade issues with China, between China and the U.S. have affected things. The value of the dollar, it gets into play there. So for soybeans, a lot of variability, all that much more possibility and likelihood of needing to look at some of these risk management tools, options, perhaps either at the money or out of the money, to help give you some protection. And there's the USDA RMA projected price coming out of the February timeframe for soybeans, 1187. For corn, it was 458. So these aren't unlofty projections. For years, the corn projected price at February average was basically $4, just a few cents off of it. So now we're 58, 60 cents higher than that. So again, and here's another situation where what do seasonal indices tell us for beans? Just about the same thing, but extending a little bit later to June and July. Note though that orange chart, we did have some run up in June and July, but anything but a clear regular pattern. So again, just the times that we're in, I guess. Mixed bag this past year. I wanted to show again the same situation out of our seasonal prices. Cash prices in Kansas for soybeans tending to run from October lows really pretty steadily, very steadily, all the way up to July highs. Now I think I see an error I put in there. I said new crop 2020-21. That should be the current crop. Sorry about that. But the current crop on the way through where we're going. Again, long-term seasonal trend up, seasonal index upward trend into July, very clear. Current futures though, with the strength we have, pretty much sideways to lower into June, and then starting to tail off heavily July and August. Current soybean futures trending sideways into June, then lower. So, but our concern is for next November. But yet, what happens up front in these futures tends to affect not just the upfronts, but has sometimes a muted effect, but still an effect on the new crop. And I want to show you the wheat numbers. We're not looking at a wheat example today per se, but from where we're at now, typical seasonal patterns, pretty much sideways from here from basically March into May. Long-term seasonal index trending sideways into May. Maybe in terms of what futures are showing, just a little bit of an uptrend. Of course, we all sit here with this, and you'll note the wideness in March of some of the variability that you can see in those price moves. So yeah, we tend to move sideways, but there's a lot of volatility in all that movement that can still occur. Okay, it's kind of heading into the home stretch on this marketing plan. So why have pre-harvest grain marketing plans? Well, Mark, as you and I have talked about in these workshops we've been offering, basically we see that there are these seasonal tendencies there, and we're at least coming up with a way to their historic seasonal tendencies, at least coming up with a way to systematically, in a disciplined manner, approach it. So pros and cons. Of course, early sales are viewed by farmers as neutral to beneficial in flat, sideways, or even bare declining grain markets. However, in the uptrending bull markets, people will, even though the decisions were good decisions, we covered costs, we did everything right, still they'll just will tend to view price movements and upward will tend to view early pre-harvest prices in markets that end up moving higher as lost pricing opportunities, and really for farmers, lost income opportunities. Key elements, of course, crop insurance, the RAM workshops we had offered out of Kansas State University, but Art and Bill Tierney in past, being involved in that, Art carrying on that for years. Key in this, in giving you an idea of how many bushels you want to put at risk in forward contracts prior to harvest. Again, what's your bushel coverage? Price targets for action points, pre-harvest pricing strategies, cost of production. I would hope there's no place better someone can come to than Kansas State University to look at our historic budgets, our current budgets, to get an idea of cost of production. Mark, a meeting you and I were at in Wichita just within the last week or so, the KSU projection for cost of production is about 325 to 350. We put in 4, with the idea that fertilizer prices, other crop input prices are going higher. So you could argue 375, 380 as well, but 4 in these markets seem to be a good way to look at it. And then of course you'd look at crop market outlook, pricing increments, targets based on seasonal price potential, and then decision dates. Mark, before we move on from this, I know in these meetings in these settings that we've been, I guess we've had strenuous discussions on what to look at in terms of setting price targets. Do you have any thoughts on that?
Well, in the workshops, we look at Kansas Farm Management Association data, and we look at all the enterprise reports, because that's a great place to start. Obviously, people always need to be looking at what their costs are, right? We need to be very, very focused on that. But in a lot of ways, it is good to kind of reflect on what those averages are for your area. I think that's just a great place to start. I think some folks, their costs may be, depending on their size, et cetera, may be way high. And that may be an unrealistic, target for a marketing plan, but definitely you need to be aware, because when you create that plan, one of the things, and I think it was the previous slides, you talked about, there's a strong seasonal that says, let's price early. But the fact that in your pre-harvest marketing plan that we set that minimum and it's covering our cost of production, it should really give you the confidence to go forward and implement that plan. And so your cost of production is just key.
And what, well, we'll come to this more so, but we have an implicit bias in this, is that if we can't meet cost of production ahead of in our pre-harvest pricing, then we sit back and we wait for a better opportunity. Am I saying that correctly?
Yes, that's exactly it. That's exactly it. If we can't cover our cost of production, you don't do it. And I think it's important that for everybody here listening, that when we do a week winning the game workshop, we're spending probably 2 hours getting to the point, I think, of the next slide where you have the marketing plan, and then we spend another hour or so working through a computer-based simulation. So we're really compressing a lot of that, yeah, you're absolutely right, Dan.
Yes. So here would be a plan, and we invite you to scrutinize this as to whether this is an appropriate way to approach it. So objective, first we start with buying insurance to figure out how to protect our production risk, i.e. what are our replacement bushels. Now we put up probably a lot stronger I guess percentage of expected crop that most people do. A lot of them are probably looking at 50% or 40% or 55 or 60 maybe. But in this situation, well, and maybe in this year where we have pretty good prices, we are putting about 75% up based on APH yield. So that's 60,000 bushels. So it's 80,000 bushel unit. And we're setting the goal by August 1st. We've looked at all these KSU and Farm Bureau charts, and they're scared to death of what can happen after that. So, and we're assuming, Mark, I changed this a little bit from last time you saw it, a 30 under basis works pretty well in most areas of Kansas, except in Southwest where we've got positive basis going on. And so we're using 6 1,000 bushel increments. $4 cost of production minimum. We won't act unless we get that. And then we start moving through time. So we would turn around on next week and we've said, well, given our plan, we're going to price 10,000 bushels at $4.30 D's corn or $4 cash. So again, these are forward pricing, forward contract basis bids, and we'll use anything that we're comfortable using: forward contracts, hedges, hedge to arrive, basis contracts, or ag options to accomplish that. So if you did that, if you put this plan in place, you get to March 10th, you'll probably, and given that the markets are up today, a dime to 15 cents, you'll probably immediately be pricing some grain. Mark, why don't I run through this, then you can come back and fill in the details. April 1st. So we're looking at the calendar, putting some dates down. April 1, price 10,000 at $4.60. But note this discussion that we have in depth on what's a top side price move. And a lot of that's on percentage seasonal moves. Add 30 cents. And there's the big or there. April 1st, price 10,000 at $4.60. D's futures or $4.30 cash, or the best price available as long as it's greater than $4 break-even price. Same thing, May 1, June 1. Note that the price goals are moving higher. And every time we do this, we run people through the simulation, there'll be a time running through May, June that you wonder if you've made a horrendous mistake because in a typical year, because the markets may not keep moving higher. But if they do, you have goals to harvest the price gains. However, if they don't, you're still looking at whatever the best thing is available to keep marketing as long as it covers your cost of production. August 1, price 10,000 at eventually get to 580, 550, or what best you can do. And then, starting March 10th, you ignore decision dates if no sale, and no sale if you can't get 4.30 futures or for cash. In this, the way we have done it here, in terms of at least your pre-harvest, we're exiting all ag options positions on October 1st. Futures hedges, hedge to arrives, all closed and delivered at harvest. Mark, what do you think of this approach?
I think it's a great approach. I tell you, I look at that though, and you think, man, there ain't a whole lot there. But I think it's a couple of things I want to point out. Number one, it is only the pre-harvest portion of anyone's plan. So, you know, whether you feed it, whether you work with an ethanol plant or a neighboring feed yard, you know, this doesn't get at, or whether you want to store it, this doesn't get at all what you're going to do post-harvest. This is only that pre-harvest plan portion. And again, we're making that recognition that, you know, we don't even have it in the ground yet, but there's that seasonal tendency that says, hey, let's get out here and see if we can take advantage of it. And the other thing I want to point out is that every number, every date, every statement in this statement here needs to be really thought through and really needs to be committed to if you're going to make this thing work. Again, there's not that much there, but again, that whole thought of, and I think Dan touched on it, you know, we ended up with 60,000 bushels. What that number is the numbers of bushels that you want to price pre-harvest. And as Dan touched on, you know, you may say, I don't want to do that much. Maybe I want to do 1/3 of expected production. You know, that's fine. You may do 50%. You may, I mean, we were, when we were down in Western Kansas, deep Southwest Kansas, there was a guy, he would have priced more than his expected production when prices ran up to a certain level. So, you know, everybody's got their own assessment of what they want to accept as risk. And that's where, you know, you've got to make a very conscious decision, because this plan is going to be making you make decisions. And again, you know, nobody knows where the price is going to go, right? You know, Dan tries to do forecasts. He analyzes it. Sometimes I do, you know, people do. Typically, especially in my case, I'm not that accurate. So we don't know where the price is going to go. What this plan does, though, is that it allows you to try to wait long enough to catch when we normally would see the best prices. For example, you know, hey, we're going to start immediately pricing if we can beat our cost of production. We're going to get 10,000 bushels done immediately. But then we're going to wait for 430 futures. So we're looking right now for a 30-cent rally. And then we're looking for a 60-cent, you know, up another 30 cents and another 30 cents. And so that makes us be patient. But we're also saying that the further we go down that line and those pricing targets aren't reached, we're going to go ahead and make that sale. So over time, you will get 60,000 bushels priced, you know, if that's the number you put at the top of the page. And so, you know, like I say, we do these winning the game pre-harvest marketing workshops, and usually they're taking us 4 or 5 hours. They're incredibly fun. So would really encourage people to contact your county extension. This is my shameless plug. Contact your county farm bureau and say, hey, we'd like to have one of these things, because we go through every one of these numbers. And yeah, Dan and I talk about why we use 75% of our APH. That's an idea, but yeah, as Dan touched on, every person who attends this needs to plug in what their number is. We've had a lot of people say, well, maybe I'll go, you know, 10 or 20 cent increments the first couple of times and then jump it up later. That's great. We want you to think that thing through, put that plan down. And I think, as Dan said before, you know, you want to be able to say, hey, oh my gosh, the market just bumped up 20 cents. Dan, should I be pricing now? No, you don't have to worry about that. You look at your targets. Did I meet them? And your response is, I've already made my sales for now. And it makes you make a lot of good decisions, spreading those sales out. But again, you know, one of the scenarios we use, because it's a computer-based simulation that we kind of use to cement the whole thing in, prices run up really quick. And so you're pricing a lot of it very early, but it's showing you take advantage of when those prices arise. And so it's, you know, again, my shameless plug, it's a great workshop. I really think this is a good way of approaching pre-harvest sales. Again, everybody's going to have their own post-harvest plan, you know, irregardless and based on their operation and their needs. But on the pre-harvest side, you know, we're all in the same boat. It ain't in the ground yet. So this is a great workshop, and I appreciate Rich's efforts to help us with this thing, and Dan's been a real leader on this, and I appreciate K-State and their leadership. And I think that once we get kind of some of the COVID issues past us, I hope to see a lot of folks at some of these workshops, because I think they're very, very good for producers.
There's two. If you use this, you'd walk into this and D's corn, I think last I looked, I think it was 480. You'd already have, on March 10th, you'd price 10,000. If it stayed there the next day, you'd price another 10,000. So you're already 20% of the way in on this. So that's, that's how you would go forth. Another thing is if you set these lofty goals, and let's say the market turns and it doesn't get to them, well, then you would have done whatever you could on these dates through time to have get something marketed that's over cost production. If you really have a year developed like that, then you'll have grudgingly been pricing your way through at something over cost. But if we really have a year like that and it endures all the way through, then your price at harvest is probably could be way below cost production. So you look back on what was twisting your arm to act on during the pre-harvest time frame and potential that they could have been pretty profitable moves. Another thing here too is, we took if Brian's still on, there was a reason for asking a sneaky reason for asking about out of the money call options. A typical year we'll have times of real doldrums in the markets. There'll be ups and downs. The consensus of the market is that, gosh, there's not much there, and never go higher. And of course, they get surprised too. But during times like that, the one thing you can do during down markets is look for out of the money call options to protect yourself on the top side. You're willing to spend 5 cents, 10 cents. It's almost a contrarian view, but the market may have no enthusiasm for where corn futures could go in April and May, good planting weather, whatever. That's a time to buy very economical call options. The time to buy calls is when at good prices when the market's trending down. So if you have that in mind, then and you're kind of positioning those, then you're better positioned if you bought cheap calls at $5 on May 1st, and if something happens on July 1st, we're moving strongly higher, well, then you're in position to go ahead and forward contract and not be worried about missing out on something higher coming up, because you've already bought your position, you bought it at a better price. So with that, we've got a few minutes left. Let me just show you some examples we worked up on some pricing, and these are pretty current. Okay, so how does a $4 break-even cash price relate to current Dees corn forward contracts put option price floors? Well, yesterday Dees corn closed at 475.5, and it's higher again today by 12-15 cents. But the February average for Dees corn the last 15 years, 439. So, it's what's surprising to me is that there's not more of a difference. But for the last 15 years, the average is 439. But you got 2 or 3 pretty high years there. The median might be a better thing to look at, the 50th percentile than the average. Forward contracts, Garden City, 487, Salina, 456, 20 under basis in Salina. Again, Garden City out there in the middle of a demand center, demand pull going on, 11 over, 20 under in Salina. Still 20 under, new crop bid this far out, pretty good bid, 456. So both of those pretty strong prices relative to $4 break even. And again, and the $4 break even is probably even a little bit high. So how about at the money? So we talk about the realities of at the money strike prices. So what's an at the money 480 strike price? This was yesterday for Dees corn, a put option for what cost 51.25 cents, which is probably sticker shock, provide for October corn price floor. Well, you've got a futures floor there. Again, you buy that put at 480 strike price, as Brian talked about. There's the premium, 51 cents and change. Brokers are just called fees. 426 floor. Now you spent 51 cents to get that, but you do have a floor. And in the futures, if you want to convert that into cash, then I went to those forward contracts, basis bids, and plugged them in. Now, those aren't assured unless you'd connect this with the basis contract. If you connect it with the basis contract, suddenly you've taken on an added amount of delivery risk. So physical delivery risk, and not just that you find yourself potentially in a speculative position, but a physical delivery. But if you do that, plus 11 basis out in Garden City, you add that on to your floor, 437, again, comfortably over cost of production. Salina, even at the 20 under basis, you're still sitting at cost of production. So Brian, your comments on what can you afford not to lose? So anyway, there you go. We've got some, even at these high, I consider those quite a bit of money to spend still. You'd spend that, you still have something covered. How about minimum price contracts? So take those same forward contracts we just talked about, and if you bought a call option to put on top of them, there'd be two things that happen, and I think I understand this right. First of all, you'd pay for the call option. The call option's 48 cents. So you take 48 cents off of the forward contract price and have a broker fee. So you turn your minimum price into 436 and a half, 405 and a half. Off of those forward contracts. But that you put yourself in a position, and Art, if you're on here, if I'm saying this wrong, tell me. This is how I understand it. So if prices start to move higher, you don't make money until you've moved high enough to cover all the cost of that put. So you make money when the futures move to 530 and over. The 480 strike price plus the premium plus the broker fee. So you start to completely clear and make profit on this for if you turn a forward contract into a minimum price contract when the futures move high enough to pay to cover all the cost of that premium in terms of the net valuation of the put. Let's take a look at soybeans. So how does a $9 break-even cash price relate to November 2021 forward contracts put options? Soybean futures, new crop, 12.30. I don't have that right in front of me now, but $1.50, $2 difference between lead contract futures and where the futures are closing. The February average is for the last 15 years, 10.24. So there's the type of year we're in. We've got over a $2 benefit for where soybean futures were this last February on average, as opposed to where they've been the last 15 years on average. Forward contracts, some pretty hefty basis levels. For the great basis for corn in Garden City, they have a wider basis for soybeans, 90 under and 55 under in Salina. So 1140 forward contract Garden City area for October delivery, 1176 Salina. How about an at the money strike, 1240 strike price soybean put option? Basically costs $1 to get that. So your futures floor, 1240, subtract off just under $1, pay a broker. That's about 1139. And if you turn that, use those same basis levels we were just talking about, you could formalize it and plug in a basis contract and you have a delivery commitment, but you're 1049, 1084. So again, we'll have sticker shock on looking at paying $1 for premiums. But even if you do that in these markets, you're still covering your cost of production by $1.50 to $1.80. So something to consider. Minimum price contracts, again, taking the same forward contracts we were talking about, buying a call option, buying a call. Call costs 90 cents also. So setting floors 1048, 1084. Anybody watching this will say, that doesn't look too dissimilar to what we were doing with the put options. And yeah, it's just a matter of how the market values puts in the calls. But we make money on this one from the 1240, and we pay the premiums, et cetera, and move to the higher side. So get 13 some. Okay, we're right at the clock. If people want to ask questions, they want to stick around beyond the time allotted that we talked about, we're sure willing to stay and help out.
Dan, we have 3 questions towards the bottom there too, I guess. There's just,
Okay.
Starting with Roger Winterhoff. I'd put the budgets in and right below that.
Okay, let's see. Roger Winterhoff asked, any thoughts on using resting offers at various prices as approaching the target dates? Roger, I have to admit, I am not, can we unmic Roger and have him explain how these resting offers work? I think I have an idea of basically we put in an order of some type. Is that in essence what you're getting to?
And Roger, I've made it so you can talk. Dan, you'll have to unmute again. And it looks like Mark had responded some to that in the chat there.
Okay.
Yeah, I guess before Roger gets on, I guess I took that to mean, whether that be a resting offer with my broker. So if I'm looking for a futures time, hey, let me know when it hits that price. Or whether it might be, if I don't want to use futures, it might be just working with my elevator and say, hey, when you get a forward contract or when futures hit this, give me a call. I want to price it. That's how I took it, and that's why I said absolutely, because that was something that was brought up, I think, at our last, at our last one in Wichita, and like I said, I think that's a great idea because the participants' thought was, I don't have time to be watching this every day, right? I'm busy, and so that was the thought. And if that's where Roger's heading, I think that's a great idea.
Well, and I remember that conversation. And here's someone that had a whole bunch of things up in the air, irons in the fire, managing all this stuff, and wondering how to put together a plan like this that could help them be unstressed or reduce the stress of managing price risk uncertainty. So I'm hopeful that person that we were talking with on this will have something structured like this, so he's not just wondering about what to do in a 30 cent rise or a 40 cent drop. Any other thoughts?
Folks, go ahead. If you have questions, you can go ahead and unmute and talk now. If you'd like to, Roger, you can do that too. Or you can put stuff in the chat if you have other stuff and prefer not to talk.
I see a question from Melanie sent to me directly. Did you change the 15th of the month? Are you talking about those specific dates in terms of May 1st, April 1st, April 1st, May 1st, July? We just arbitrarily chose those dates. It could be just as justified to come in at the 15 because you're trailing those WASDE reports, U.S. new information in the market. That would work pretty well until you got around what are going to be big dates in this year. Again, March 31st prospective plantings, June 3rd, end of June acreage reports, the quarterly reports there. Any more market information coming in is moving the markets will be the plantings and the stocks used to tell how things have moved. So there is an issue of how many decision dates do you want to have? I think we've tackled that one too. Do you do it every week, every 2 weeks? It depends how you want to approach this. Nothing wrong with doing that, but the more often you do it, the more you become basically an average pricer. That'd be my thought. Mark, any thoughts on that?
Yeah, well, again, that's one of those things. Again, every date we use, every price we use are things that you need to kind of be thinking about and be committed to. So yeah, I guess, yeah, I don't, I think it's kind of, how do I couch this? My personal bias is I don't want to have to be making too many increments, but I think, if you're a fairly large producer and we're talking, hey, I'm trying to price, 300,000 bushels. Well, probably you want to make quite a few, smaller increments. But, if I'm a smaller producer, I've got, 300 acres of corn, then all of a sudden, you start, because I would say you want to make these in 5,000 bushel increments. That way you can either use a forward contract, you can use futures, options, whatever you want. Heck, that could be nearly, 25% of your production. So, automatically you're already doing it in quarterly increments. So again, it kind of fits. Your increments are going to be based on kind of your size. And again, how often you want to be tied to watching these things.
Yeah. Mark, we've been around enough on this that our past history is coming back on us. Melanie said, well, she took a class earlier and we used the 15th. And Melanie, I just want to tell you that was all Mark's fault. Mark, no, I think I made that decision. But the first tended to work. If really what we kind of shifted to was probably were the quarterly reports and the information that was coming out in June, here in March and June, and every day following that, you're likely to get a fair amount of volatility in the market. You could argue maybe you need to go ahead of that too, but so if the information coming into the market now will be that planning stuff, and that you probably get a bigger taste of that on the first of the month.
It takes some real strategic thinking. I'm not that. I struggle making those kind of decisions on the wins, but we've had that discussion of do I do it before or after USA reports? And it's like, well, okay, if it's a bullish report, you're going to really would like to be making that decision later, right? If it's a negative report, you would be wishing you would have made that decision afterwards. And so I don't know if there's a whole lot of magic in that, but I think it does. What we're trying to do is spread this thing out and force you to make decisions.
Art, I see you're on. Do you have a comment on that?
I was just going to add, when you're talking about smaller producers, they do trade minis. And I've traded a lot of mini corn, and especially soybeans. Soybeans trade in 1,000 bushel contracts. I like a lot more points. I just put the offers out there and let them set until they get there. So I'm not watching it every day. They'll fill if we get there. But there's a lot of volume. If you go look, there's a lot of volume in the mini soybean contract. The other factor in my case is I'm not really a soybean grower. I'm tied to canola. Canola is traded in Canadian dollars, and it's a 20 metric ton contract, which sounds like a lot, but it's not. It's 800 bushels. So the full size canola contract is roughly the size of a mini soybean contract, which has got some interesting relationships too. So the other thing with the minis is if you're worried about liquidity or being able to get out, it's not a real big problem, because if you got 5 minis, you can flip them over to a full size contract and get out. So you don't have to necessarily get out under a mini either. So although I'm confident there's enough volume in the soybean side of that you won't have a problem. But if you do, you can always go to the big board by simply getting to 5 contracts.
Yes. Speaking of canola, the irony of that is that, right? So now we have sky high canola prices, and
tell me about it.
and the delivery point out in Western Kansas, I think, is they're planning to discontinue that. So that's on a whole nother thing. So that, I guess, that's basis risk, isn't it, Mark?
That's yes.
That's
along
basis
with
risk.
Yeah, along with futures risk. Yeah.
Well, Rich, we're past our time. What do you think? Should we keep going? Did anybody else have questions?
I think we're about done, but if anybody does have a question, now's your final chance. Last call.
Well, thank you so much, everybody. And Mark, thanks for hopping in on this. I really appreciate it.
Oh, hey, it's my pleasure. Thanks so much. Everybody have a great weekend.
Thanks, Mark and Dan and Brian. Thank you. Appreciate you all being on. And folks, I'll be sending out an email with the recording links and stuff like that later today. Thank you.
Thank you all. Thank you, Brian.